Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, with the NASDAQ and the S&P 500 slipping into bear territory, investors are understandably nervous. So let's take a moment, step back, and put bull markets and bear markets into context.
Sure, Steve. I mean, we're all told and we advise people to invest for the long term. But there's another layer to that. First, you have to actually put yourself in a position to invest for the long term, which usually starts with some form of a diversification, having some protection or buffer that will give you peace of mind in your portfolio is a good place to start. Now, that protection will be different for everyone. You know, for a retiree, that might mean having enough money in cash to secure a specific number of years of income since you're in retirement. Or for someone in the accumulation mode, it might mean having enough bonds or alternatives which help reduce volatility in your account, which will help prevent you from overreacting during tough times. Everyone's buffer or protection might be a little different, but having one in place will help provide the courage needed to actually invest for the long run.
That's true. And Travis, if you do the work up front and put yourself into a position to invest for the long term, boy, does it pay off, as we know, being in the business, 24 years,
right.
25 years now. So let's take a look at the chart on the screen. Going back to 1942, the average bear market for the S&P 500 lasted 11 months, with the average drawdown of being right at around 32%. Which obviously doesn't feel good.
No, it doesn't.
On the other hand, the average bull market lasted 4.5 years, much longer than a bear market, and had an accumulative rate of return of 154%, which is much higher.
Much higher, and you know, bull markets can be great creators of wealth, Steve, as we know. So different chart, same time frame, going back to 1926 that you talked about. In those 96 years for the S&P 500, 25 of them had negative returns, and the average drawdown during those years was about 13%. On the flip side, 71 of those 96 years were positive, and the average return, 21%. A lot more chance of upside in that time frame.
There really is, Travis. The longer you stay invested in stocks, the greater chance you have of seeing positive returns in your investments. The chance of having a positive return in a stock, if you just invest for one day, is 53%. The number jumps or moves to 97% if you stay invested for 10 years. So it just goes to show the longer you stay invested, the better chance you have of making money.
That's very true, Steve. And just one more chart, since we're showing a lot of charts, today. I want to reinforce that the media's goal is to attract your attention, and they're going to try and shock you and scare you in the process. It's the best way to attract your eyeballs. And if you listen to them, there's always a reason to be scared to invest. But looking at the bigger picture, most of what they broadcast is noise, which really distracts you. It doesn't help you achieve your long-term goals.
So true, Travis. Look forward to it next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.